a subtopic as cost of capital. So we go to a subtopic as the cost of capital. So it is still about the financing decisions. So we shall simply be able to check how to go about in order to get the total cost. So we can introduce by writing that. It is the required rate of return. It is the required rate of return by the investors. It is the required rate of return by investors who have provided funds to the company. It is the required rate of return by investors who have provided funds to the company. They include number one will be cost of equity. Number two, cost of the preference shares. Then number three, cost of the debenture. Number three will be cost of the debenture. So we can start with the cost of equity. So under the cost of equity, we write that equity refers to the shareholders' funds. Equity refers to the shareholders' funds. It can be categorized into two as follows. Roman letter 1, ordinary share capital. Roman letter 1 is the ordinary share capital. Roman letter 2 will be retained earnings. Roman letter 2 will be the retained earnings. So you can start the Roman letter 1, which is the ordinary share capital. We can start off with the Roman letter 1, which is meant to be ordinary share capital. Ordinary share capital. So under that, we write that ordinary shares are classified into two as follows. Ordinary shares are classified into two as follows. They are classified into two as follows. So the first dash will be zero dividends. Zero dividends, growth rate ordinary shares. Ordinary shares. So the first dash will be zero dividends, growth rate ordinary shares. So what I will do, I will simply be giving you the formula of how to get that cost of capital. We shall not go into details explaining what it is. So I will simply give you the formula of getting the cost of the ordinary share, which has got zero dividend growth rate ordinary share. So KE will be the cost of capital, will be equal to D divided by PO, then you minus F, then you express it as a percentage. So KE is the cost of the ordinary shares, D is the dividend per share, PO is the current market price, then F is the flotation cost. So KE is the cost of the ordinary share, D is the dividend per share, PO is the current market price per share, F is the flotation cost, then we express it as a percentage. So that is now the first dash, the zero dividend growth rate ordinary share. The second dash would be constant dividends. Constant dividends, growth rate ordinary shares. Growth rate ordinary shares. Growth rate ordinary shares. We also have constant dividends, growth rate ordinary shares. Constant dividends, growth rate ordinary shares. So for this one, KE is still the cost of the ordinary share, will be equal to D1 divided by PO, P minus F. Then we add G like that, which is the same as DO in the brackets of 1 plus G divided by PO minus F. Then we add G like that. So our D1 is the next dividend to be paid. Our D1 is the next dividend to be paid. DO is the last dividend that was paid. So D1 is the next dividend to be paid. DO is the last dividend that was paid. DO is the last dividend that was paid. Then G is the constant growth rate. G is meant to be the constant growth rate. G is meant to be the constant growth rate. PO we already know, F we already know it. So PO and F we already know. But now D1 is the next dividend to be paid. DO is the last dividend that was paid. So that is now about ordinary share capital. We said that equity was classified into two, ordinary share capital and retained earnings. So let us now go to the retained earnings. We now go to the retained earnings. Let us now go to the retained earnings. We now go to the retained earnings. So when it comes to the retained earnings, we write that our internal source of finance, our internal source of finance, our internal source of finance, which will not attract the flotation cost. Our internal source of finance, which will not attract the flotation cost, which will not attract the flotation cost, which will not attract the flotation cost. Then we condemn by writing that. Therefore, the cost of the retained earnings, therefore, the cost of the retained earnings, therefore, the cost of the retained earnings is the same as the cost of the ordinary share. Therefore, the cost of the retained earnings is the same as the cost of the ordinary share. It's the same as the cost of the ordinary share, except that there will be no flotation cost, except that there will be no flotation costs, except that there will be no flotation costs. And it is calculated as follows. And it is calculated as follows. So I will just repeat what I've done for the ordinary shares. I will just repeat what I have done for the ordinary shares. I will just repeat what I've done for the ordinary shares. But now I've said that now there will be no flotation. So the first dash, we say that in case of zero dividend growth rate ordinary share. So this one we change to KR, representing the cost for the ordinary share. But the rest of the detail is the same. Now we remove the quotation cost. Now we remove the quotation cost. Even this one you see is constant dividend growth rate ordinary share. Also, even this one, you change this one to KR, then you remove the quotation. Everything will remain the same, except there is no flotation cost. Then we change KE now to KR to reflect the retained earnings. So all the details will remain. All the details will remain.
To make it as a percentage.
Finally, the answer will be a percentage. Yeah, but now I cannot multiply by 100 because this one is normally a percentage, but because it is attached to this others, to make it a fraction. But now the final answer, you will be getting it as a percentage. The final answer, which make it as a percentage. So that is all about the cost of equity. That was now about the cost of equity. So we now go to the cost of the preference share. We should now go to the cost of the preference shares. After the cost for the equity, we now go to the cost of the preference shares. We should now go to the cost of the preference shares. So for the cost of the preference shares, I will just give you the formula. So for the cost of the preference share, I'll simply give you the formula. So the formula will be KB will be equal to D divided by BO minus F. Then show it as a percentage. So cost of the preference share will be equal to D. B is the dividend per preference share. BO is the current price of the preference share. Then you also subtract the quotation cost. So it may appear like the one for the ordinary share with the zero dividend, but what I've said, KB is the cost of the preference share. T is the dividend on the preference share. The other one was the dividend on the ordinary shares. But this one is now the dividend on the preference share. This one is the price of the current price for the preference share. We still incur some flotation cost. So that is all about the cost of the preference share. Finally, the last one will be cost of debenture or bond. The last one should be cost of the debenture or the bond. The last one should now be the cost of the debenture or bond. The last one should now be the cost of the debenture or the bond. We now go to the last one as cost of the debenture or bond. So under that, we summarize that it is classified into two categories. 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 Roman letter 1 will be irredeemable debenture. Roman letter 1 will be irredeemable debenture. Roman letter 1 will be irredeemable debenture. So I'll just be giving you the formula. So KD will be referring to the cost of the debenture. It will be equal to interest. Interest, then 1 minus the corporate tax. we divide by the current value for the debenture minus the flotation cost. Then we express it as percentage. So it is simply going to be interest. This one is representing interest, then 1 minus the corporate tax, divide by current value for the debenture, subtract the flotation cost, express it as a percentage. So that is interest. This is the current value for the debenture, you minus the flotation cost. So that is now cost of irredeemable debenture. So we got the Roman letter to as redeemable debenture. Redeemable debenture. Redeemable debenture. So for the redeemable debentures, you write that the cost of this debenture, is also known as the yield to maturity. The cost of this debenture is also known as the yield to maturity. The cost of this debenture is also known as the yield to maturity. The yield to maturity, and it is expressed as follows. And it is expressed as follows. It is expressed as follows. So KD will be representing the cost for that debenture. It is the same as yield to maturity. It is the same as the yield to maturity, which is supposed to be equal to interest. You get interest, then 1 minus the corporate tax. Then you will add in brackets market value of the debenture. We subtract the current value for the debenture. 1. We divide again by this one, multiplied by, then you express it as So this one I said is interest. This one should be maturity value. This one is the maturity value. This is the current value. Then N is the maturity period. Maturity value. The same. This now here the same. Here now still the same. So interest
In
N is the maturity period. N would be the maturity period. Then MD is the maturity value. Then this other one is the current value for the debenture. Maturity value for the debenture. Then N is the maturity period. N is simply maturity period. N is simply the maturity period. So that's now how we shall be computing the cost of the debenture, which is redeemable. We have three items there: maturity value, current value, and the maturity period. Then interest is the same. Then we can also have a brief subtopic as methods of computing the constant growth rate. Methods of computing the constant growth rate. We can now have methods of computing the constant growth rate. Methods of computing the constant growth rate. So under that, we can summarize that the constant growth rate in the ordinary share, the constant growth rate in the ordinary share, the constant growth rate in the ordinary share can be computed using any of the following methods. The constant growth rate in the ordinary share can be computed using any of the following methods. Using any of the following methods. Using any of the following methods. Roman letter one. So Roman letter one will be. So Roman letter one will be compounding method. Compounding method. So Roman letter one will be the compounding method. So we already know them, but I'll just be giving the formula. So G, the constant growth rate, will be given by N, then Gn divided by Go, then by H. So G will be equal to this the root N. So Dn divided by Do, then we shall subtract 1. So 1 is not covered by the root, 1 is independent. But when we do a question, I will be explaining what we mean by Do, Dn, what is N, what is G. But for now, we just have the formula like that. Then number 2 will be retention ratio method. Number 2 will be retention ratio method. Retention ratio method. Retention ratio method. So to get G will be given by R and multiplied by. So I will explain what each one of them stands for. So to get our G, simply be equal to R multiplied. So where R is the retention ratio of the profits. R is the retention ratio of the profits. R is the retention ratio of the profits. Then this other one is return on equity. This other one is the return on equity. The return on equity. So this one is return on equity. This one is the retention ratio of the profits. So when we do a question, we shall be explaining those items. So apart from that, let us also write something brief about breakpoint. We also write something brief about breakpoint or critical point or a critical breakpoint or critical point. You can also write something brief about the breakpoint or simply a critical point. So breakpoint or the critical point, we write that it is the point of financing. It is the point of financing. It is the point of financing where a given component source of finance, where a given component source of finance is exhausted. It is the point of financing where a given component source of finance is exhausted. A given component source of finance is exhausted. So that the investor uses the next expensive source of finance. It is the point of financing where a given component source of finance is exhausted, so that the investor uses the next expensive source of finance. So that the investor uses the next expensive source of finance. It is normally expressed as follows. 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 So to get the breakpoint is given by amount to raise. Amount to raise. Then we divide. So to get the breakpoint, simply get the amount to raise, we divide by the weight. We just get the amount to raise. So the weight is the same as the proportions. So when we do the question, you will get to understand those weights. So now we go to a question in your past papers. There is a question for September 2021, question 4, part B. We go to September 2021, question number 4, part B. September 2021, question number 4, part B. We now check September 2021, question number 4, part B. September 2021, question number 4, part B. September 2021, question number 4, part B. So that question 4, part B, it reads that Dynasoft Limited is capital structure. Dynasoft Limited capital structure, which it considers optimal, is given as follows. Which it considers optimal is given as follows. So the venture capital is 25 million. So equity has two components, kuna reserves and ordinary share capital. They have also given you preference share capital. So additional information, not number 1. The firm's historical earning per share and the dividend per share over the last 5 years are given as follows. Over the last 5 years are given as follows. So you can see the pattern 2016, 2017, 2018, 2019, and 2020. So what you 2016, you name it as DO. 2016 will be DO. 2017 will be D1. You name them. The first one is DO. The second one will be D1. 2018 will be D2. 2017 will be D3. 2020 will be D4. So which means N will be what? N will be 4, because the first one is period 0. The first one will be period 0. So 2016, you name it as DO. 2017 is D1, D2, D3, and what? D4, like that. Then they were also able to come up with a note number 2, where they said the company's ordinary shares currently sell at shillings 50 per share at the securities exchange. So new ordinary shares will be sold at this price. Note number 3, the company's expected net income for the year ending 31st December 2020 is 40 million. Dynasoft Limited adopts a constant payout ratio of 40% as it is dividend policy. Then, note number 4, the company can raise additional capital as follows to finance acceptable investment projects. Equity capital, utilize all available retained earnings for the year ended 31st December 2020. Any extra equity capital will be raised through the issue of the new ordinary share at a flotation cost of 10% of the issue price. 10% of the issue price. Also, preference share capital. New preference shares will be issued at 11% coupon rate. The bar value of each share is 100. New preference share will be issued at par, subject to a flotation cost of 5 shillings per share. Debentures. New debentures can be sold at a coupon rate of 13%. The debentures will be issued at par. The corporate tax rate is 30%, so required. Roman letter 1. Calculate the breakpoint in the marginal cost of capital schedule. Roman letter 2. Weighted marginal cost of capital in each of the intervals between the breakpoint. Roman letter 3. Dynasoft Limited has the following potential investment opportunity projects. Initial cash outlay, internal rate of returns are given. So there is project B, W, X, Y, and Z. Initial cash outlay has been given. They were also able to give you internal rate of return, so required. Using investment opportunity schedule. Advice on which project to accept and hence determine the optimal capital structure. So what you do first, just get the weights or proportions. First, come up with the weights or simply proportions. So to get the weight or proportions, just go to the initial capital structure. Check the first paragraph. So equity. So we are looking for the weights or proportions. Weights or simply proportions. Weights or the proportions. So weights or the proportions, equity. Equity has 2 items there, reserves and ordinary shares. Reserve is 15 millions. Ordinary share, you can see 45 millions. Then divide by the total, you can see the total is 100. So that will be the weight or the proportion for equity. So equity has 2 components there, the reserves and the ordinary share capital. So that should give us 0.64 or just 0.6. 0.6. Then the other one is the preference share capital. The preference share capital. For the preference share capital, you can see it is 15 million. Also divide by 100. So 15 divided by 100 should give us 0.15. You do the same for the debentures. So for the debentures, it is meant to be 25 million. Also divide by 100. So 25 million divided by 100 million should give us 0.25. So those are the ways. Some questions will give you those proportions in the form of the percentages. But now this one, they gave it in terms of the amount. So we want to answer the Roman letter, where they wanted you to calculate the breakpoint in the marginal cost of capital. They would like you to get the breakpoint. So we only calculate a breakpoint where they have specified the amount to raise. We only compute a breakpoint where they have specified amount to raise. So in this question, the only area I've seen the amount specified is there in the note number 3. When you got the note number 3, they said that the company's expected net income for the year ending 31st December 2020 is 40 million. Dynasoft Limited adopts constant payout ratio of 40%. 40%. So if we pay dividend at 40%, we retain how much? 60%. So we want to get a breakpoint. So breakpoint is supposed to be given by amount to raise. We divide by is amount to raise. We divide by the rate. So the only item we have there is the retained earnings. The retained earnings. So to get the amount to raise from the retained earnings, you got the note number 3, where they pay out 40%, which means the retained earnings to be 60%. So get 60% of 40 million. 60% of 40 million. That would be the amount from the retained earnings. We get 60% of 40 million. To give us, it will give you 24 million. So we get the breakpoint for this figure. We get the breakpoint for this figure. So amount to raise from the retained earnings is 24 million. The amount to raise from the retained earnings is the 24 million. So I have to divide by the weight. Retained earnings is part of equity. The retained earnings is part of equity. Got 0.6. So divide by 0.6. The weight, 0.6. The retained earnings is part of equity. So the proportion is 0.6. We had seen that value. We had seen that particular value. So there was no other area they mentioned amount to raise. If the ordinary share could have specified the amount to raise, we could have also calculated the breakpoint for that. If the debentures could have done the same, we could have also calculated for it. Also, if the preference share, but they didn't, we only compute a breakpoint where they have specified amount to raise. So this one, that's the only item we had. So we want to go to the Roman letter 2. Roman letter 2 is the weighted marginal cost of capital. So before you get the weighted marginal cost of capital, we shall be calculating the cost of capital for the retained earnings for the ordinary share, for the debenture, and also for the preference shares. Before also we go to that, when you want to calculate the cost of the ordinary share, one item was not given, that is the constant growth rate. So let us see how to get first the constant growth rate. So the growth rate for this question, you will use the compound method. So for this question, we lack the constant growth rate in the ordinary shares. We lack the constant growth rate in the ordinary shares. So we use the compounding method. G is supposed to be given by N. So Dn divided by D4, then we subtract 1 like that. Then we subtract 1 in relation to that. Then we subtract 1 from that. Subtract 1. So we had agreed that we go back to the note number 1. We said that 2016 will be D4. Yeah, then 2017 will be D1, D2, D3, and D4. So we said that N will be 4. So that will be D4 divided by D4 minus 1. So our D4 is the dividend in the year 2020. Are you able to see the year 2020? 3.6. Then 2016 is 3. So get that constant growth rate. Get that constant growth rate. Then you also express it as so that figure could also be given by, that figure could also be given by 3.6, 3.1. So the order of each is the power of 1 over 4. So you can also write it this way. When the answer you get, express it as a percentage. The answer you get, remember to express it as anyone who has computed. Anyone who has computed. I've seen 4.66%. So you can use this one. This one is easier. This one is easier, whereby You simply take 3.6 divided by 3 to get the answer. Then on your calculator, remember you have this. You see this sign on your calculator? Yeah. Just take 3.6 divided by 3, press the answer. Then after you have pressed the answer, your calculator has this sign. Then press this sign. Then maybe you can open the brackets. Then 1 divided by 4 plus again the brackets. Like that. Then press the answer. Then once you have done that, you subtract 1. Then the answer that you get, express it as a percentage. Yeah, this one is easier. What you do, simply go to your calculator, press 3.6 divided by 3.0, get the answer. Once you get the answer, your calculator has this sign. Press that sign. Then your calculator also have the opening brackets. Then 1 divided by 4, also get the closing brackets. Press the answer. Once you have done that, subtract 1. Then you multiply by 100. So that should be able to give us 4.66%. Yeah, I hope everyone is comfortable with that figure. Are we all comfortable with that figure that we are getting? We have been able to get a figure of. We have been able to get a figure of 4.66. So now after that, I go to the cost for the retained earnings. I now calculate the cost for the retained earnings. So now calculate the cost of the retained earnings. So cost of the retained earnings, this question has a constant. So I'm first of all calculating the cost of capital for each. So cost of the retained earnings. The cost of the retained earnings. So KR, because it has a constant dividend, KR will be given by DO in the brackets 1 plus 3, then divide by PO. Just the same as B1, which is the same B1. Sorry, I put up rotation because B1 divided by B4. G. So one thing I would like you to remember, I said that DO1 is the next dividend to be paid. DO is the last dividend that was paid. So you follow the pattern. Not number 1, they have said that the firm's historical earning per share and the dividend per share over the last 5 years. You see that over the last 5 years. So which means that DO is the last dividend that was paid. The last dividend that was paid in that portion is in the year 2020. Yeah. When it comes to DO of this place, is not the same as the DO for calculating G. When we are calculating G, we use the past. When we are calculating the cost of capital, we are looking for the future. So remember, this one will be the year 2020, the last dividend that was paid for the last 5 years. So which means D1 will be the year 2021. We agree on that. Our DO of here is not the same DO that you used to get G is not the same DO that you apply to get what? G. Our D1, our DO is the last dividend that was paid. Our DO is the next dividend to be paid. So get at this point, DO is the 3.6. DO is the 3.6. 1 plus G. G is the constant growth rate, which is 4.66, which is 4.66%. It's the same as 0.08. Divide by PO. PO is the current market price, not number two. They say that the company's ordinary shares currently sell at the securities exchange at how much? 50. Then also add 0.04. So the answer you will get, express it as a percent. (12.2%). So that is for the retained earnings. That is for the retained earnings. So we go to cost of the ordinary share. Cost of next one should be cost of the ordinary share. So to calculate the cost of the ordinary share is the same as K. It is DO, then 1 plus G divided by BO minus the flotation cost. It's the same about the retained earnings. The only difference now there is flotation on. So all the details we have used for the retained earnings remains. So this now will be 3.60, 1 plus G, which is 0.04. Minus the flotation cost. Flotation cost was given to you in the note number 4 under equity. You see note 4 under equity, they have said that utilize all available retained earnings for the year ended 31st December 2020. Any extra equity capital will be raised through the issue of what? The new ordinary shares at a flotation cost of what percent? 10% of the issue price. So 10% of the issue price, that flotation cost, simply get 10% of the issue. You simply get 10% of the 50 shillings. 10% of 50 is the same as what? The same as 5. So you subtract 5, then you still have. Then express it as a percentage. Then express it as. So that one we give you with percent. 13.0. So that was now about cost for the ordinary share. We shall also compute the cost of the preference share capital. We shall also be required to compute the cost of the preference share capital. We now also compute the cost of the preference share capital. So cost of the preference share, cost of the preference share, cost of the preference share is the same as KB. Remember KB, it is D divided by 4 minus then you express it as a percentage. So I would like you to go to the note number 4. There is a place for the preference share capital. In the note number 4, there is a place for the preference share capital where they say that new preference shares will be issued at 11% coupon rate. The bar value of each share is 100. New preference shares will be issued at par. So our dividend will be 11% of the bar value. Dividend is 11. The coupon rate is the dividend rate. 11% of the bar value, which is that will be the same as what? Yeah. So our PO is the current price. The current price is the same as the issuing price. They have said it was issued at what? At par. You see the par. That new preference shares will be issued at par. Our PO is the current price of the issue price. So it is still being issued at par. The par value is. It was issued at par. And the bar value has been given as what? Then F was given as 5 shillings. So now our KB simply gets the 11 divided by 100 minus 5. Express that figure as a percentage. Express that value as a percentage. Express that value as a percentage. So we go to the cost of the debenture. We now also compute cost of the debenture. Also calculate. So that debenture is irredeemable. When it is irredeemable, simply because they have not given us the maturity period. When there is no maturity period, means it is what? Irredeemable. So KD will be equal to interest 1 minus the current value of the debenture. We subtract the flotation cost. Express it as a percentage. Express it as a percentage. So interest is normally calculated on the bar value. The interest is normally calculated on the bar value. The coupon rate is 13%. So they said that in the note number 4, new debentures can be sold at a coupon rate of what percent? 13%. So it is 13% of the bar value. 13% of bar. Interest is normally calculated on the bar value, but it was not given. We just have it as 13% of the bar value. So we come at this point. So interest was, the bar value was not given. So this region for the interest simply have 13%. Oh. The corporate tax was given as what percent? The note number 5. So 30% is the same as 0 point. So we divide by, this is the current value for the debenture. That is also given under that. So the new debenture can be sold at a coupon rate of what percent? 13%. So the debenture will be issued at what? At par. The debenture was issued at par. So this current value for the debenture is the same as the par value. It was not given. It was not. So flotation cost is not there. Then you express it. Also, this bar value and that bar value will cancel. This bar value, it was not given, but because it was issued at par, we just cancelled it. So finally, it will be 13%. Minus 0.3. Then we will express it. Because it's already a percentage. Check that out. The 13% is already a percent. It will finally give that 9 point what? 9%. So that is how you have to get bigger. So they did not give you the bar value, so we could not be able to see how to calculate the value for that question. So from there, you are now supposed to get the weighted marginal cost of capital. You are meant to calculate the weighted marginal cost of capital. You are supposed to get the weighted marginal cost of capital. You are supposed to come up with the weighted marginal cost. So weighted marginal cost of capital is supposed to be given by the weight of equity or by the cost. Weight of the preference share, the cost of the preference share, the weight of the debenture, the cost of the debenture, which is after the tax, which is always after tax. So you had been given some details with respect of that element. We gave you some details. So I will do a small summary. So first, I will start off with equity. I will start off with. So under equity, we calculated KR. KR cost of the retained earnings, it was 12.12. So KE, the cost for the ordinary share, we got which was 13.0. Then we calculated the breakpoint for the retained earnings. You remember the breakpoint in the Roman letter 1 for the retained earnings? It was which here? It was 40 million. So these details you have, I only want to have them once and so that we apply them at that portion. Then there is the preference shares. There is the preference shares. So for the preference shares, there was no breakpoint, but we calculated KB for the preference share. So KB was which? 11.5 each. Then kuna hiyo debentures. There is Debentures, we have also calculated. The debentures also calculated. AD for the debenture was 9.9. So there was no breakpoint for this one. Then there is also the summary for the range. Summary for the range. So the first range normally start from 0 to the lowest breakpoint. There was only one breakpoint, which is 40. Which is 40. Then the second one will be above 40 million to the next. So there was no next that was given. The next just get the total cost of all the projects. You see the Roman letter 4, Roman letter 3. Are we able to see the Roman letter 3? Total initial cost, add them. Project B is 10 million. Project W is 20 million. X is 10. Y is 20. Z is what? 10. So when you add them together, they give us a total of. So this 40, you have it there. So the range, we normally start from 0 to the lowest. But now it is also only one, which is 40. Then the next one must be above 40 with the next breakpoint. But there was no other breakpoint. But now I've just used the total amount we got for all the projects. You see that? So we have two WMCC. The first one, you have to calculate our WMCC. So the first one should be from 0 to 40 million. The first one will be from 0 to 40 million. So WMCC, the weight of equity, this one is equity. It's not ordinary shares. This one is not equity. Equity has two components, retained earnings and not ordinary shares. So when you are under equity, you see equity is this 40 million and below, we use 12. When it's above 40 million, you will change to ordinary shares. So the breakpoint is 40 million. 40 million is for the retained earnings. So 40 million and below, use the retained earnings. Above 40 million, we change to what? Ordinary shares. These others had no breakpoint, they will apply to all of them. This one has no, this one has no breakpoint, the other one. So when we started the question, we calculated the weight of equity. Remember the weight of equity? It was 0.1. But we are from 0 to 40 million. We are below 40 million and below. You apply 12. Then we also calculated the weight for the preparation. And you check when we started the question, the weight for the preference share was 0.1. So you take 0.15 because there was no breakpoint for the preference share. This will apply to all. So this will be 11. Also confirm for me, what was the proportion for the debenture? 0.25. So also there was no breakpoint for the debenture. So you still use 9.1. This 9.1 was after the tax. So remember we taxed it. So don't tax it again, just visit the 9.1. KD must always be after the tax, but we have already taxed. So it is already after tax. So that is now from 0 to 14. 0 to 14. So the second one is the one above. 40 million to 70. 40 million to 70. This one now. So it is still the same concept. 0.6. But now, anything to do with the above 40 million, remember to use what? The ordinary share, which is starting point, which is starting. These others are not affected because there was no break point in them. These others are not affected because there's no break point in them. The only item that is changing is the one for equity. Equity had two components, the retained earnings and the ordinary share. It had two components, the retained earnings and the ordinary shares. So that is now your Roman letter 2. That is now your Roman letter 2. So online, I hope it is clear to everyone. So those who are online, make sure that it is clear to everyone. So the remaining part, I will finish it in the next class. So the remaining part will be the Roman letter 3. So Roman letter 3, we shall finish it in our next class. Remember to remind me when we do the next question, before we do the next question. So you can stop there for today.
Mm.